Welcome to another episode of Priced It with Jenny Capital Markets. And today we'll be talking about this 200 million commercial building that we are going to share with you a little bit more about the proposed plan on how we are going to do AEI, how we're going to increase the rental and eventually increase the exit price, right? This is a huge asset. It's 200 million, but we have pitched to some of our buyers. They have concurred with our analysis, and that's the reason why we are going to bring it online. So today we have none other than Justin, who is actually part of the commercial team. He's actually the brainchild behind the commercial team, and he's the person who is analyzing all the numbers for us as we meet like all the institutional investors and all of the retail investors as well. And if you're new to our channel, we are JNA Real Estate. But if you're new to this episode, Price It is part of our capital markets initiative, where we're doing our best to share with you how we will help you if we represent on the buy side, to show you how we usually analyze deals, and for you to understand a little bit more whether is this the team that you want to represent, and also whether is this the way that you have analyzed the plots yourself or the asset yourself as well, right? So today we have this 200 million dollars asset, commercial building that has been in the market for some time, but we also want to share with you why we think it's not moving, and if you're the buyer, how much will you then offer this plot for? Justin, why don't you take it away?
So today we'll be looking at this building, through the lens of a buyer. So you'll see its surrounding, its potential, its estimated rental, as well as then the price.
That's right.
Price.
So this is in District 1, right? And tell us a little bit more about this very complicated asset class, because there's a lot of parts to this commercial building, There are some shop houses here and there. There's a school, right? So tell us a bit more.
Currently it's a existing 4-story building with, of course, there is the conservation block as well. So on the land size of 28,000 square feet approximately, and a built out of 78,000 square feet. So later we'll go to the details of like the respective buildings, but let's take a look at the area of the District 1 first.
All right, so tell me a little bit more. For District 1, how do you feel this area is? D1 homes the most expensive shop houses and buildings in the market, right?
Yes.
And rumors have it that Jackie Chan also owns something there.
Yes.
Or used to own something there.
I think he still
owns something there. And it's one of the most monumental iconic row of shop houses in the area, right? So tell us a little bit more about this area, and how has the master plan like for this area?
So this property is located in District 1, so that we can see from the master plan, right? District 1 is filled with commercial activities. So
dark blue.
Dark blue. And as well as like the hotels in the light purple zone. Right? Also very nearby all the national monuments. Why we break down the master plan is because we will want to see what we can use, what we can potentially change the building to, and also what are some of the developments that are around the area that we can tap onto.
So there must be an allure towards the core central region. Not that we have asked a lot of our residential retail buyers to buy CCR, because we understand that in terms of the residential investment landscape there in the secondary market, it's not the strongest, but there is a very strong demand for own stay buyers as well. So tell me a little bit more about what are some of the 进展, the progress of developers in the core central region. I don't even know where 进展 is correct now, but it should be there. Okay, let's talk about D9 first, right? I know there's something very interesting happening in place that we reminisce a lot as army boys. Tell me more about D9.
So the next development that will be there is Robertson Walk. I think that's where Kampai is. That's where you're referring to.
Yes.
So this property is located, it's near Clarke Quay District 6 as well as District 1, but it's located in District 9. So Fraser Property is looking to redevelop Robertson Walk, right, in a joint venture with Secretary House. Right. It will consist of a residential development as well as mixed-use options such as F&B and entertainment.
330,000 square feet of space. Can I just dig your brains a little bit? Why would someone want to partake in a development project that is so big, especially in the commercial scene? Do you think that the reason behind that is to increase the yield so as to exit? But there's a lot of things to exit. I think it's most likely a yield play, right? Or what do you think is the reason why they want to do this improvement? Because not only this, I think later on we'll talk about Boat Quay as well, where they say that changes are happening, but I honestly don't see much changes, but I think it has already happened, right? So tell me a little bit more. Why do you think someone is willing to go through this 330,000 square feet of space, of risk as well?
I think previously this development was owned by Fraser. So I think they saw that it was probably at the right time to actually redevelop this space because they have been holding for quite a while. And now that they are under a 999 years lease, they probably want to exit.
Yes.
Yeah, and in fact, this is actually one of the smaller development in the core central area compared to the rest. Wow. 330,000 square feet is, I think, the smallest.
Wow.
Yeah.
So just curious, Sekusui is the developer that is also behind Ori, right? Which I've joined invested in. I'm just wondering, what is Sekusui doing in the Fraser? I'm not Fraser, in the Robinson Walk area.
Yeah, I believe Sekusui will be handling more of the residential side. Yeah, I think mainly Fraser will still continue to manage the mixed-use area, which is the F&B and entertainment.
I see. So there is some new residential
potentially
progress that's going to happen in the area as well.
It's near to Fort Canning MRT station as well.
Yeah, not too bad. Okay, let's talk about the other side of the core central region, right? Where we have one of the... I mean, it has already been launched, this project. Wasn't a good sellout, but understandable because pricing was quite reasonable, but I think the marketing wasn't done the best. Let's talk about District 7, CCR, right? We have the launch of Aurea. So tell me a little bit more about this whole area and what is happening in this CBD, in this CCR area.
Yeah, so Aurea is a mixed development with office, residential, medical, as well as retail space. So it's across 856,000 square feet of space.
Big.
Yeah, so actually the residential is just one component, one block here, right? We can see, right? The remaining part is where they are doing the office, right? Medical as well as retail space. Where I think Far East as well as Perennial, as well as Sino Group is
coming together.
Coming together to develop this.
It's not easy to redevelop Golden Mile.
Yeah, especially it's conserved.
It's conserved and it's considered like a historical monument in Singapore. Hey, better make sure they do a good job. But come on, these are the biggest players, one of the biggest players in the market.
So we can see that there's a lot more. Developers' confidence in this area. I'll say in the core central area. This is at Bugis. Just now, the one is at District 9, right? Robinson Walk. I think next we also can look at somewhere at Clarke Quay.
D6,
Right, Clarke Quay, we have another joint venture with CDL as well as CapitaLand.
So CDL has been on the news a couple of days, but I'm just very happy because I see that the father and son decided not to sue one another, and I think, I'm no right to go and I'm no one to go and intrude in their life, but I think that is what family unity is more important than the business as well, right? But there's so much things is happening. So CDL and CapitaLand has decided that they did a JV for Killing Piers, right?
Yeah, so I think it's going to be ready in a few years' time. And it consists, Canning Hill Pier consists of the residential space, service apartment, hotel, as well as retail space, right? Over 1.1 million square feet of space.
Now I understand why you say 330,000 square feet is very small.
Yeah.
And I can imagine the amount of backing these developers have to say, let me take out 1.1 million square feet in Singapore.
Yeah, exactly. Right. It's also very nicely situated right on top of like Fort Canning.
That's right. Beautiful place as well. So why is this then important for buyers?
Yeah, because from a buyer's perspective, right, if I'm a buyer, if I can buy somewhere that is near these big developments, then being built by these developers, right, then I will be when I want to consider a use from the property that I'm buying near this development, I don't have to worry too much about the amenities. Because these are already taken care of by this developer when they want to do such large scale developments.
It's like being a tree inside a very beautiful lush forest. Right? I'm just assured of my surroundings. I just need to make sure the human traffic is going to be there. I just need to make sure that I develop properly and people will come
So, I know that there will be amenities that will support my tenants so I just need to be responsible for my building. And I know that even if I fall short of certain F&B or amenities in my building, they can take care for me.
Got it. Okay, let's talk about Clarke Quay then. CapitaLand has been rejuvenating Clarke Quay with a total of 290,000 square feet in total. Tell me, why are they doing this?
I think this will be the next logical move for them, right? After developing Canning Hill Piers, because of the amount of square feet that is set aside for residential, service apartment, as well as hotel, right? The next step is to probably logical steps to rejuvenate Clarke Quay lah, so that they can prepare for the residents coming in.
That's very responsible of them.
Yeah, I mean,
but there's a different reason as well. It's to increase the yield, I believe.
Increase the
and
yield,
utilizable space.
Yeah, definitely one of it, because Clarke Quay back then is very old.
There's almost nothing.
Yeah,
so for drinking.
Correct. Yeah. So now there is even a fair price.
There's even a dog pool. I brought Jonah there.
Wow.
To swim.
Yeah, so there's also fair price there. There's just, all these kind of lifestyle amenities kind of be preparing for the residents that are coming in, as well as like the short-term guests that they're looking at the service apartment there.
Yeah.
Right. So all these amenities would, they're also hoping on the increase of footfall, right? To be able to increase their rental yield there as well.
So do you think that CapitaLand is going to sell Clarke Quay?
Not anytime soon.
When do you think they'll sell it?
I don't think they'll sell such an iconic place.
No, so I'm just thinking that most of the time, like, it's like a real estate private equity play, right? Sometimes people, they increase the yield because they are planning for exit, right? To tidy up the numbers a bit first, right? But it's true, like, Clarke Quay is so iconic. What's the reason why they'll sell it, right? Yeah. But just in case they decide to sell it, at least we have said that we said it before. So I think the reason why we are sharing with you all of these advancements as well as rejuvenation of the cost control region is because to share with you that Singapore CCR hasn't died, and people are spending a lot of billions of dollars just to rejuvenate this space, right? And the reason behind that is just to bring more life, because more life, more human traffic, which comes with better amenities than current existing amenities, do increase the rental yield, which eventually increase the asset price. So means these developers do have the vested interest to be able to just rejuvenate the space, right? Yep. And this is important because in this asset that we're talking about, right? We're going to share with you and just give you the confidence that, hey, this area is okay, right? And in District 1, we're going to share with you now what is the proposed plan for this $200 million asset. And at the end of the session, we're going to share with you a little bit more about what we think will be the entry price, which I tell you, it will surprise you, okay? All right, so let's talk about the proposed plan then. Yeah.
All right. So this is the rough plan. I mean, of course, we don't put the exact address and all, just to protect
the owner's interest.
Just to protect the owner's interest. So it looks something like that. We have a main block, right? And then at the side, we have the conservation part.
Yeah.
Right? So the total GFA is about 77,500 square feet, right? Comprising of these two blocks, with the main block consisting of about 66,000 square feet and the conservation site about 11,500 square feet.
77,500 square feet in total, right? Yeah.
So what the team proposed to use for the conservation area is to actually portion it up for commercial activities such as F&B, restaurant, gyms and cafe . This is mainly to serve the working and residential crowd around the area.
So tell me a little bit more about what the current asking rentals and the PSF is, so that we can kind of estimate how much it will be rented out at, and then we can estimate the yield a little bit as well. Yeah.
Yep. So if we were to take a look at the asking rental in District 1, right, we can see that the asking rental ranges from $9 per square feet to about $12 per square feet. So this is what is being listed right now. Of course, this is not entirely accurate to use this figure, right? Because some of them
are still in the market.
Yeah, in the market, right? Then sometimes we have F&B that will command a better premium.
Yes.
Then if you're on the second floor, then sometimes you don't get
that kind of rental.
Right? And but it's good to know what they are currently asking, right? So that we know what our neighbors are asking.
Yeah.
But for us to calculate actually the potential rent, right, it's better to look at what has already been transacted.
Yeah. So tell me a little bit more about how was the transacted rental between January 2024 and January 2025, so that we can kind of have a more accurate representation. Yeah.
Yeah. So if we were to take a look at what has been transacted between January 2024 and January 2025, these are for property types for the retail and shop house . So this is actually extracted from URA under the commercial rental analysis, right? We can see that the rental rates, right, are going at about $7 all the way to about $18 per square feet.
Which is very high for the museum.
Yeah, for the museum area. I think that's where the tourists are, right?
Correct.
Yeah. So looking at this, right, averagely we can see that somewhere in the middle here, we can use $8 per square feet as a conservative figure, right, to use in our calculation.
Which seems quite fair actually, right?
Yeah, so how
7 to 18, I wouldn't expect 8. I would expect 10 at least. Yeah.
So we will use about $8. This is just the average.
Yeah.
So how do we do this is that we will use the total area, GFA area, right? We will reduce 15% for space efficiency.
Communal space, yep.
And then that will be your net lettable area.
NLA at about 9775 square feet.
And then multiply by $8 per square feet. So we'll get about $78,200 per month for the conservation block.
So this is the conservation area. So what then is the proposed use of the main building?
Okay, let's take a look. So for the main building, we have an estimated about 66,000 square feet of GFA.
Yep.
So the team has actually proposed to use this area as a co-living space or a service apartment with a hotel license.
Very, very popular now with co-living areas. And maybe before we go on, why do you think co-living is something that you would consider? Is it because there's a higher rental? Do you think that because it circumvents some regulations for now? Or what is the reason?
As a buyer?
Yes.
Yeah, I think co-living, if it will be something that I consider because firstly, I don't have to allocate compared to hotels, I don't have to allocate too much for amenities. If I'm doing a hotel, I have ballroom,
that's true.
I have all these other spaces. Being co-living, it makes it more lean. Where most of my area is just for living space. Right? And also is easier to manage. Not too much operations involved. So I think this is why co-living spaces are currently quite trendy.
And it affords a little bit more of a longer term rental without having to compromise on the residential rental rules and regulations as well.
Especially if you have a hotel license, then it also gives you the additional flexibility of doing short term stays as well.
So question is based on your proposed plan of a main building, which is not a hotel now, It's like a school, right? So the question is, how then do you estimate, how many rooms do you estimate that you will have this co-living room?
So in order for us to find out, then we have to firstly also, like what you mentioned, find out the number of rooms that we can have. And then also to look at how much are the asking rental in this area.
Fair. Right. Let's take a look.
So we'll use this example, right? Just to roughly understand what's the room size, right? In the Core Central region. So this is Union Square. There's where CDL is developing, right? I think 735,000 square feet of GFA for mixed-use development, right? So based on the information that we can find online, right, we can see that they are planning for 134 rooms, co-living with hotel license on 48,860 square feet of space, right? So if we were to break it down further, if we were not to consider any communal space, there's no space efficiency, we just lump it together. If I use 480,000 square feet divided by 134 rooms, that will give us about 364 square feet, right? Per room, including the corridor space. Right? If I were to factor 15% of the entire GFA, which is the net lettable area, just to be the rooms, if I divide by 134 rooms, each room will be 309 square feet.
So at this kind of square feet, right, how many rooms can we then have? Okay. I can't count. Quick math. 100 plus, 170, 80.
So if we, based on what we observed earlier on, right, for 364 square feet of space, which where the corridors, communal space is merged together, the rooms, right, we can use about 181. Right. Similarly, if you were to do a 15% space efficiency, right, and divided by the average room size of 300, we also can use, we use the same.
So what are your thoughts on a 364 square feet or 309 square feet room? Is it considered small or is it like...
It's quite reasonable. So actually, why we need to actually find out the average room size, right? Because we also want to compare what are the asking rental around us, so that we know that the monthly rate that we are charging is not ridiculous for the kind of room size that.
And from my understanding, I think these rooms are 309 square feet. Even though it sounds very small for one bedder, it's actually quite big for hotels and co-living spaces. Really, am I right?
Yeah.
So based on what you have mentioned about the rental for the main block and conservation building, can you do a combination and share with us a little bit more about what the total estimated rental is going to be?
So in summary, right, based on the respective usage as well as the net lettable area after factoring space efficiency.
15% space efficiency.
For both the commercial space as well as the 181 rooms, right, we are looking to, the estimated rental is about 612,000 per month. So with that figure in mind, right, as a buyer, then I would want to work on what's the price that I'll be comfortable to offer. Because I know that's the rough estimated rental that I'm going to get, right? So...
let's go on to the calculations and see what our entry price is with a target rental yield, right?
So for development this size and with a tenure of slightly above 65 years, right, we would like to see a rental yield of between 4 to about 4.5% returns.
So why 4 to 4.5% is the sweet spot that we're looking at?
Because in the core central region, if you look at the shop houses, right, the freehold shop houses, your rental yield is about maybe 1-ish, 1.5 to at best 2%.
Yeah.
Right? So for something that is this big, right, you got almost 70,000 square feet of GFA, right?
Yeah.
And it being leasehold, you would want to look at about 4% to about 4.5%.
And it's a good asset for kind of capital preservation. I'm very certain we can push for capital appreciation, which maybe if you were to meet us up individually, we can talk to you. Maybe we'll just throw the QR code here. If you're interested in this asset, you can scan it. Or if your fund is interested in this asset, you can just scan it. But let's just talk a little bit more about what price. Then do we think the target price will be, right? At 4% and 4.5%.
Yeah. So just looking at just the rental yield, right? For rental yield of 4%, the price will work out to be 183.6 million, right? At the rental yield of 4.5%, the price will be about 163.2 million.
And there's definitely going to be LBC costs for this, right? So this is not going to be the offer price you're looking at?
Yeah.
Exactly. Tell me a little bit more about the costs involved as well.
It's
going to be a lot.
We'll be looking at two major costs that's involved in making our plan come true, right? Because there will be costs involved, right?
Yeah.
So first we have the LBC. I think previously you did a video with
Alvin about LBC, yes.
So why is LBC involved, right? Because firstly, we are intensifying the land usage, right? From currently a commercial land usage to something that is more premium, which we're hoping to do something with a hotel license, right? So how do we account for the LBC here? First, we use the difference, right? In the group provided by the SLA, the table, right? Multiplied by the GFA of our building, right? Also, the thing to note is that this number here given by SLA is for freehold. So ours being leasehold, right? We also have to discount it based on the table in Appendix 2, right? Which shows the leasehold value as a percentage of freehold, right? In order to come out with the LBC that's
which
payable.
Is about $18 million.
So this is about 18 million.
Okay, what about the renovation cost? I mean, you're not going to just keep it as it is, right? So what is the renovation cost involved?
Yeah, so currently the building is already about 30 years old. So
and this photo is actually done by AI.
Yeah, right?
It looks really good actually.
Yeah, so the building itself, the current building itself is already 30 years old. So definitely we need to renovate it in order to get a good renter, right? So we'll use the entire building, right, to calculate the renovation cost, not just the co-living part, but just the entire GFA just to be a bit more conservative, right? So we use $250 per square feet for the renovation cost. That will bring up to about 19.3 million.
Got it.
For the renovation cost.
Yeah. So the target price that we will be looking at the 4% or 4.5% yield will be at 146 million for a 4% yield projection, and then also 125 million, 125,825 for a 4.5% rental yield, which is really interesting because I mean, this particular owner who's owning this asset has been listing this asset for sale for a long time. We don't represent this owner at all. That's the reason why we can comment. And at 200 million, and there hasn't been much success in the sale of this property. And I think from there we can understand a little bit why. So what's the reason why we kind of estimate at 4 to 4.5%? Is because when we have spoken to a lot of our ultra high net worth as well as institutional investors, a lot of them, they're looking for yield play because they want capital preservation or maybe make their money work a bit more effective for them without having to put in too much time and effort to rejuvenate the entire asset. So 4 to 4.5% is fair, right? So as we're coming to the close and the end of this Price It by JNA Real Estate, we have given you our target price by the commercial team. I just want to understand a little bit more from your end. Do you think that this asset, if I were to enter at a 4.5% rental yield or 4% rental yield, assuming that the owner is willing to accept at this price, right? 146 million or 125 million, do you think there's going to be a capital appreciation potential?
Yeah, so the capital appreciation part will come with account to the rental price. I mean, for commercial assets, usually buyers will peg their price to the rental yield. So the capital appreciation part will also, we will also have to look at what is the current rental and what's the rental that we think that we will be able to achieve in the next 2 to 3 years. Right. But if let's say they were to increase by 10%, 15% or 20%.
There will be an increase in capital appreciation prices as well. And I think that with a new asset in, right? I mean, a brand new asset with a brand new license. Even if we were to bring down the rental yield to about 3% or 3.5%, we already have some potential gains that we can already get, right? At the current productivity of the asset. Of course, AEI can be done. This proposal requires way more time. Actually, we already have that proposal that we have been pitching to some of the funds and institutional investors. And if let's say you are keen, just contact us. We'll be more than happy to share with you. Of course, if you are keen to buy, right? Not keen to just understand, right? Because there are some private information that we don't share only if we have done the clearance check with the buyers as well, right? Any last thoughts on this asset before we close? What do you think about a $200 million asset like this? Do you feel that it's something that is actually palatable for the market? Or do you think that, if you have 200 million, you'll buy more things rather than one thing? What do you think?
I think it really depends on the appetite of the buyer. I think if, let's say, you were to want to focus your resources on just one, right, just to manage it well, then of course, getting in at the most, we got to get in at the best price, right, in order to manage it well. But of course, if let's say you like to diversify, buy a few smaller shop houses or building, then you have to take up the
risk of management. Because it takes time to manage.
So then the more resources have to be allocated to different parts. And then you might not be able to price each of the assets that you acquire as sensitive. So it really depends on the appetite of the buyer.
I think like what you mentioned very accurately, the appetite of these buyers have an appetite of 200 million if they have an appetite of $1 billion. Right? You won't have an appetite of 200 and buy 200 immediately, which we have met investors who have the appetite of $1 billion. Just that we can't post because this is private. Just curious, right? And I share my thoughts about it as well. So as a commercial player, as a commercial investor, right? Would you then, Justin have seen canteens, coffee shops, buildings, we have seen shop houses, so many things. We've done HDB shop houses, canteen, so many things, right? And we have seen the returns of our investors as well. So for this is not even considered a mid-market asset. This is considered really a high net worth asset, right? A huge asset. Would you rather diversify your risk, or would you rather put all your eggs in one basket?
Actually, it really depends on how. If let's say I were to diversify between 2 to 3 assets, I don't mind. But if I cannot find anything like to diversify in between 2 or 3, then I will probably consider this one. Fair. Because I will not go for like maybe 10
or 20 assets. Fair. I was thinking that the management of 10 to 20 assets is crazy. I'd rather put my eggs not just in one basket, but maybe 2 or 3 as well. Thank you so much for your time with us, Justin. And you know what? We really appreciate you for watching this episode of Price It with J&E Real Estate. And this whole capital markets initiative was done up because we just want to share with buyers how we really think about assets like this. Whether is it big, whether is it small, anything that contains investments, we want to be part of it. We want to help you with the analysis. And most importantly, we also want to learn from you how you usually do big asset classes investments like this. All of these analyses have been checked with numerous investors with track record before we even pitch this out into the market, so that we make sure that we are providing objective and good content. So we just appreciate it that you guys are watching us on this capital market series, right? We thank you so much for your time with us. We hope to see you for the next episode. This is Jervis.
This is Justin.
And we'll see you for the next episode of Price It with J&E Real Estate. Bye-bye.